20.3 Income Redistribution. This chapter covers how government redistribute income, income tax, income maintenance programs, subsidized services, positive and normative theories of income redistribution, major welfare challenge, negative income tax. Income inequality refers to how income is distributed unequally across the population. Income redistribution is when income is redistributed throughout the society so as to lessen the income inequality that's present. Income redistribution aims to promote economic stability and possibilities for society's less affluent members, essentially narrowing the gap between the poor and the wealthy, and so frequently includes financing for social services. Because these services are paid by taxes, people who advocate for income redistribution claim that higher taxes for the richer members of society are necessary for best programs benefiting those who are underprivileged. The three main ways in which governments in the United States redistribute income are income taxes, income maintenance programs, subsidized services. Income taxes. Income taxes may be progressive, regressive, or proportional. A progressive income tax is one that taxes income at an average rate that increases as income increases. A regressive income tax taxes income at an average rate that decreases as income increases. A proportional income tax, flat rate income tax, is one that taxes income at a constant average rate regardless of the level of income. The income tax rates that apply in the United States are composed of two parts, federal and state taxes. Some cities, such as New York City, also have an income tax. There is variety in the detailed tax arrangements in the individual states, but the tax system at both the federal and state levels is progressive. The poorest working households receive money from the government through an earned income tax credit. Successively, higher income households pay 10%, 15%, 25%, 28%, 33%, and 35% of each additional dollar earned. Income maintenance programs. Three main types of programs redistribute income by making direct payments in cash, services, or vouchers to the people in the lower part of the income distribution. They are social security programs, unemployment compensation, welfare programs. Social security programs. The main social security program is OAS-DHI, Old Age, Survivors, Disability and Health Insurance. Monthly cash payments to retired or disabled workers or their surviving spouses and children are paid for by compulsory payroll taxes on both employers and employees. All federal poverty programs today amount to 20% of the total federal budget. The major programs are Social Security, which is a contributory federal retirement program, and Medicare, which is a subsidized program for those over 65 years old. These two programs transfer payments in the United States and in most other high-income countries. Unemployment compensation. To provide an income to unemployed workers, every state has established an unemployment compensation program. Under these programs, a tax is paid that is based on the income of each covered worker, and such a worker receives a benefit when he or she becomes unemployed. The details of the benefits vary from state to state. Welfare programs. The purpose of welfare is to provide income for people who do not qualify for Social Security or unemployment compensation. They are Supplementary Security Income (SSI) program designed to help the neediest elderly, disabled and blind people. Temporary Assistance for Needy Household program designed to help households that have inadequate resources. Food Stamp program designed to help the poorest households obtain a basic diet. Medicaid designed to cover the cost of medical care for households receiving help under the SSI and TANF programs. Subsidized services. A great deal of redistribution takes place in the United States through the provision of subsidized services provided by the government at prices below the cost of production. The taxpayers who consume these goods and services receive a transfer in kind from the taxpayers who do not consume them. The two most important areas in which this form of redistribution takes place are healthcare and education, both kindergarten through grade 12 and college and university. The scale of income redistribution. Household market income tells us what a household earns in the absence of government redistribution. The market income is not the official basis for measuring distribution of income. The Census Bureau's measure is money income, market income plus cash transfers from the government. But market income is the correct starting point for measuring the scale of income redistribution. We begin with market income and then subtract taxes and add the amounts received in benefits. The result is the distribution of income after taxes and benefits. The value of subsidized services such as college. The resulting distribution might understate the total amount of redistribution from the rich to the poor. Figure shows how government action changed the distribution of income. Part A shows two Lorentz curves and compares them with the line of equality. Figure 1, the blue Lorentz curve describes the market distribution of income, and the red Lorentz curve shows the disposable income, that is, distribution of income after all taxes and benefits, including Medicaid and Medicare benefits. The Lorentz curve for disposable income, which tells us that the distribution of disposable income is more equal than the distribution of market income. Figure B shows the redistribution increases the share received by the lowest 3 quintiles and decreases the share received by the highest 2 quintiles. The sources of income at different income levels provide another measure of the scale of redistribution. The poorest quintile receives 80% of its income from the government. The second quintile receives 32% of its income from the government. In contrast, the richest quintile receives almost nothing from the government and receives a third of its income from capital interest, dividends, and capital gains on financial assets. Positive and normative theories of income distribution. The redistribution of income creates what has been called the big trade-off, a trade-off between equity and efficiency. The big trade-off arises because redistribution uses scarce resources and weakens incentives. A dollar collected from a rich person does not translate into a dollar received by a poor person. Some of it gets used in the process of redistribution. Tax collecting agencies such as Internal Revenue Service and welfare administering agencies, as well as tax accountants and lawyers, use skilled labor, computers, and other scarce resources to do their work. The bigger the scale of redistribution, the greater is the opportunity cost of administering it. But the cost of collecting taxes and making welfare payments is a small part of the total cost of redistribution. A bigger cost arises from the inefficiency, deadweight loss of taxes and benefits. Greater equality can be achieved only by taxing productive activities such as work and saving. Taxing people's income from their work and saving lowers the after-tax income they receive. This lower after-tax income makes them work and save less, which in turn results in smaller output and less consumption, not only for the rich who pay taxes, also for the poor who receive the benefits. A good positive theory of income redistribution would explain why some countries have more redistribution than others and why redistribution has increased over the past 200 years. Why don't have such a theory, but economists have proposed a promising idea called the median voter theory. The median voter theory is that the policies that governments pursue are those that make the median voter as well off as possible. If a proposal can be made that improves the well-being of the median voter, a political party that makes the proposal can improve its standing in an election. The median voter theory arises from thinking about how a democratic political system, such as that of the United States, works. In this system, governments must propose policies that appeal to enough voters to get them elected. In the voting system, the voter whose views carry the most weight is the one in the middle, or the median voter. The major welfare challenge. Among the poorest people in the United States are young women who have not completed high school, have a child or children, live without a partner, and are more likely to be black or Hispanic than white. These young women and their children present the major welfare challenge. There are about 10 million single mothers, and a quarter of them receive no support from their children's fathers. The long-term solution to the program of these women is education and job training, acquiring human capital. The short-term solution is welfare, but welfare must be designed in ways that strengthen the incentives to pursue the long-term solution. And a change in the US welfare program introduced during the 1990s pursue this approach. The current approach, TANF, passed in 1996, the Personal Responsibility and Work Opportunities Reconciliation Act created the Temporary Assistance for Needy Families TANF program. TANF is a block grant that is paid to the states, which administer payments to individuals. It is not an open-ended entitlement program. An adult member of a household receiving assistance must either work or perform community service, and there is a 5-year limit for assistance. These measures go a long way toward removing one of the most serious poverty problems while being sensitive to the potential inefficiency of welfare. But some economists want to go further and introduce a negative income tax. Negative income tax. The negative income tax is not on the political agenda, but it is popular among economists and it is the subject of several real-world experiments. A negative income tax provides every household with a guaranteed minimum annual income and taxes all earned income at a fixed rate. Suppose the guaranteed minimum annual income is $10,000 and the tax rate is 25%. A household with no earned income receives the $10,000 guaranteed minimum income from the government. This household pays income tax of minus $10,000, hence the name negative income tax. A household that earns $40,000 a year pays $10,000, 25% of its earned income to the government. But this household also receives from the government the $10,000 guaranteed minimum income, so it pays no net income tax. It has a break-even income. Households that earn between $0 and $40,000 a year receive more from the government than they pay to the government. They pay negative income tax. A household that earns $60,000 a year pays $15,000, 25% of its earned income to the government. But this household receives from the government the $10,000 guaranteed minimum income, so it pays a net income tax of $5,000. All households that earn more than $40,000 a year pay more to the government than they receive from it. They pay a positive amount of income tax. A negative income tax doesn't eliminate the excess burden of taxation. It does improve the incentives to work and save at all levels of income.